Hi, I'm Tom Miller, Director of Investment Strategy here at Girard. Welcome back to Investment Currents. In part one, my colleague Tim covered the quarter's market environment. Today, we're staying with the Hotel California theme and turning to one of the most consequential stories in wealth management over the past several years, private credit. You've likely seen the headlines, so let's walk through what this asset class actually is, why it grew so fast, where the risks are, and how Girard is thinking about it. So, what is private credit? At its simplest, private credit is lending done outside of traditional banks and public bond markets. A private credit fund pulls investor capital and lends it directly to companies, typically middle market businesses with anywhere from 10 million to 1 billion in annual revenue. These are real operating companies, often sponsor owned, with meaningfully higher leverage than what you tend to see in public markets and fewer financing options if conditions tighten. These loans are usually floating rate, indexed to SOFR, and senior secured. Investors access the space through private funds, business development companies or BDCs, and increasingly through interval funds. Direct lending makes up the bulk of the market, about 65%. But the broader category also includes asset-based lending, specialty finance, mezzanine debt, and real estate credit. The basic trade-off is straightforward. Investors accept limited liquidity, meaning fewer opportunities to access capital, in exchange for higher income. And the growth has been extraordinary, expanding from roughly $200 billion in 2009 to nearly $2 trillion today, with much of that occurring over the past 5 years. So why did the asset class grow so quickly? Two reasons. On the supply side, banks pulled back. After the financial crisis, regulations like Dodd-Frank and Basel III made it more expensive for banks to hold these types of loans on their balance sheets. As a result, bank lending as a share of GDP fell from about 59% in 2008 to roughly 44% by 2025. When public credit markets seized up during COVID in 2020, private lenders stepped in with capital and certainty. On the demand side, the appeal was clear. Yields in the 8 to 11% range in a near zero rate world with floating rate exposure layered on top. RIA adoption accelerated rapidly, and interval fund usage jumped sharply in just a single year. Direct lending issuance reached a record $327 billion in 2025. One important point here. Growth explains why capital flowed in. It doesn't tell you whether the underlying risks were being priced correctly. So what is the difference between public credit and private credit? Public credit trades daily on exchanges. Prices are set continuously by the market. Liquidity is readily available and transparency is high. Private credit is different. Loans are typically priced quarterly by the manager. Liquidity is limited, often constrained by scheduled redemption windows, windows to sell the investment, and disclosure is far more limited. Because these assets aren't marked to market daily, returns tend to look smoother. That smoothness, however, comes from how and when the assets are priced, not from lower underlying risk. Lower reported volatility does not mean lower risk. This is the most important chart in the deck, and it's worth pausing on. As a reminder, anything rated below BB is considered speculative grade, often referred to as junk. That label isn't subjective. Historically, it simply reflects a higher probability of stress or default across a full credit cycle, with multiple tiers below that into single B and triple C territory. On the left, you see public leverage loans. The credit quality distribution has been relatively stable over the past decade. About 42% of loans are rated B plus or higher, with roughly 30% rated B minus or below. Now look at private credit, 77% of loans are rated B minus. When you include triple C plus and below, 93% of private credit sits at B minus or worse. Only about 2% is rated B plus or higher. That's an enormous concentration of lower quality credit risk. The yield premium in private credit exists for a reason. It compensates investors for materially weaker underlying credit quality than what you'd find in a traditional leveraged loan portfolio. We think the risks can be grouped into three areas. First, the rules got sloppy. As capital flooded in, competition for deals intensified among lenders, the funds. Covenant protections for investors weakened, credit quality deteriorated, and payment in kind interest, where borrowers add interest to the loan balance instead of paying cash, rose from about 5% in 2022 to more than 11% by the end of 2025. When borrowers can't service debt in cash, that's important. Think of it as extending the term of a 30-year mortgage when you're unable to pay. Second, the illusion of stability. Quarterly manager marks create the appearance of smooth returns. Some have called this volatility laundering. The portfolio may be under pressure, but you don't see it until valuations catch up. Third, the liquidity trap. Many interval funds and non-traded BDCs allow redemptions only at fixed quarterly windows, often capped at 5% of net asset value. When redemption requests exceed those limits, investors are prorated. Liquidity is most constrained at the very moment investors tend to want it most. These risks aren't theoretical. They're currently playing out in real time. Blue Owl permanently restricted withdrawals from its $1.7 billion retail fund. Cliffwater's flagship, a $32 billion fund, saw redemption surge from 5.3% to roughly 14% of NAV in the first quarter. S&P revised the outlook from stable to negative. Non-listed BDC redemptions tripled quarter over quarter. The U.S. private credit default rate climbed to 5.8%, the highest in years. And on the right side of the slide, the Wall Street Journal published more articles on private credit in the first 3 months of 2026 than in all of 2025. The headlines speak for themselves. Investors cashing out in droves. This story has moved from the back page to the front page. So where does this leave us? We chose not to allocate heavily during what many described as the golden age of private credit. Underwriting standards hadn't been tested across a full cycle, and transparency around valuation and incentives varied widely. Looking ahead, our view is more measured than binary. Private credit can play a role as a satellite exposure in certain portfolios, but we do not view it as a substitute for traditional fixed income. 3 points are worth keeping in mind. Reported smoothness is a function of pricing, not protection. Structure matters more than advertised yield, and historically, the more attractive entry points in credit tend to emerge during periods of stress, not during periods of easy capital. Thanks for watching. As always, please reach out to your Girard advisor with any questions, and we'll hope to see you again soon.